What we have seen over the last 12 to 18 months is something quite incredible. We have seen a synchronized property boom across our entire country, and it doesn't seem like that growth is slowing down anytime soon. With so much growth in such a short period of time, the question that is on everybody's minds right now is it too late to invest in property? Are we going to see a correction soon? Hey guys, welcome back to the channel. For those that are new here, my name is Zeng and I make weekly videos on the topics of real estate investing and other forms of wealth creation. So if that's something you're interested in, please subscribe to the channel for more content just like this. In today's video, we are going to look at the macroeconomic factors surrounding our property market. We are going to look at the property cycle, and we are going to look at some examples of how I personally navigate this crazy market. As always, this is not financial advice and I am not a financial advisor. I'm simply sharing with you my personal opinions and strategies, and I will always recommend you to do your own research and seek the help of real financial experts before jumping into any big financial or investing decisions. Without even looking at the latest data, we already know that this property market is red hot, and quite frankly, a bit out of control. Record low interest rates combined with very generous government stimulus programs have created a lot of demand in our markets, and the sentiment in our market right now is absolutely insane. And we also have a massive shortage of supply. The cost to service mortgages has never been lower. This combined with a rapid increase in property values has given landowners and homeowners absolutely no reason or incentive to sell their properties. For those that are thinking about selling their property, they are very excited about the prospects of selling their property in such a hot market and getting top dollar. But they are also worried about buying another property once they sell, because they will be buying in a very competitive market. We can look at this like a traffic jam, and there are more and more people lining up to buy properties, but the supply of properties is not increasing and there's still a massive shortage. In fact, according to data released by CoreLogic, there are around 1.1 sales for each property that is listed onto the market. This is only going to make things worse because the line of buyers is only getting bigger and bigger. To give you an example of just how crazy things are right now, I was recently helping a friend with her property search in Adelaide, and we found this really nice property that was listed for $320,000 to $350,000. Look, this is definitely not a blue chip suburb. It is around 25 k's from the CBD, and the income and employment data shows an income that is slightly lower and an unemployment rate that is slightly higher than the South Australian average. This market did, however, have extremely low vacancy rates, redevelopment potential because of the large land size, as well as strong rental returns. And the days on market for this particular suburb has been decreasing rapidly. Before we even made an offer on this property, we already know that this was going to be extremely competitive. But what happened next blew my mind. Before the first inspection, there were already 7 offers on the table, and 230 people attended the first 2 inspections, and the vendor received 25 written offers. Just to give you some context, I have been keeping an eye on this market for a while now, and just 12 months ago, we were able to purchase very nice property here for around $300,000 to $330,000. However, what the property sold for was unbelievable. The property ended up selling for more than $400,000, and the successful purchaser was a first home buyer who had missed out on 7 other properties, so she made damn sure that she would not miss out on this one. Look, I am extremely happy for this first home buyer who finally managed to get her first property. However, I definitely think she overpaid, assuming that she paid $400,000, but my guess is that she paid a lot more than that. That will give this property a growth of more than 30% in the last 12 months, which is absolutely mind-blowing and very unsustainable. Let's talk about why this is happening in our markets. Obviously, there is the record low interest rates and the crazy demand, but there is one factor that a lot of people are overlooking, and that's the fact that it is now cheaper to own a property than to rent a property, thanks to our record low interest rates. Positive cash flow is something that I've been talking about on this channel for a very long time now. For an investor, positive cash flow simply means the rental income is more than enough to cover all of your repayments and expenses. But let's now look at it from the renter's perspective. We will also use this property in Adelaide as an example. Obviously, everybody needs somewhere to live, and they have 2 options. is either to rent or to buy. Currently, a property like this will rent for $370 or $390 a week. However, if we now take a look at the NAB repayment calculator, if she borrows $400,000 and takes advantage of the 3-year fixed rate of 2.09%, her weekly principal and interest repayment for a $400,000 mortgage will be $345 per week, which means it is cheaper for her to buy a property than it is for her to rent a property. And of course, it makes much more sense for you to pay off your own mortgage instead of paying off someone else's mortgage. Obviously, there are a lot of costs associated with home ownership, such as council rates, insurance, water rates, maintenance, and other expenses. But most first home buyers simply ignore this or grossly underestimate this because they just want to achieve the dream of owning a home. With the government providing forward guidance and indicating that they will not increase interest rates until at least 2024, it will only encourage more renters to become first-home buyers. Combined with all the government stimulus programs that encourage first-home buyers to purchase property for only a 5% deposit, and the use of lenders' mortgage insurance becoming more and more common, it will only encourage this kind of behavior to continue. And this will make perfect sense because the demographic of buyers that is driving the markets right now are mostly owner-occupiers and first-home buyers. However, there are some constraints to this, and that of course is affordability. Because even though these first-home buyers and these owner-occupiers want to buy into the property market, they can only do so if their borrowing capacity allows it. I understand the argument that our bigger cities like Melbourne and Sydney have more high-paying jobs, and that is 100% correct. But houses in these markets are also much more expensive and much less affordable. I personally prefer to invest in a market where the average person on their average income can afford the average property, because I think affordability goes a long way in supporting and sustaining growth. If we look at the affordability in our major cities, there is definitely a difference between some of our markets. Melbourne and Sydney definitely stand out as the more unaffordable cities relative to income. Other markets like Perth, regional Victoria, regional New South Wales, Adelaide, Brisbane, and some parts of regional Tasmania still have relatively good affordability. And that's why I see more opportunity in these markets compared to our biggest markets. The thing to understand here is that every single market in Australia is going through their own property cycle. And these cycles consist of many different phases from early recovery to downturn. If we look at markets like Melbourne and Sydney, which have done extremely well over the last 2 decades, where do you think they are on this property cycle? My personal opinion is that these markets are heading into the mature cycle. And a trigger for a potential downturn in these markets will simply be affordability, as people can no longer afford to pay higher prices. If you have been watching my videos for a while, then you know what I'm about to say next. So let me ask you a question instead. If I told you to put Perth somewhere on this cycle, where would you put it? Personally, I would put it somewhere between early recovery and expansion. We are finally starting to see some growth in this market after a very long downturn. And with such high incomes in a market where housing supply is so low, I see a lot of potential. You guys know I'm a big fan of Hobart, and I have a lot of investments in Hobart and the other Tasmanian cities. However, due to the level of growth that we have seen in these markets so far, I personally believe that these markets are starting to head into the mature phase of the cycle. For that reason, Hobart and Launceston are not markets that I'm currently looking at investing into. So does this mean I'm going to sell my properties in Tasmania and put the money into other markets? Definitely not. I still see a lot of potential in these markets because no one can accurately predict the top of a market. But my current focus are on markets where I see better opportunities. To give you some context on how much these markets have grown by since I purchased them, I'm going to show you an example of one of my investment properties in Hobart. In 2018, I purchased a property in a suburb called Lutana, which is around 6 kilometers or a 10-minute drive from Hobart CBD. This suburb was considered as a suburb for people of lower socio-economic class, which did concern me a bit. But the vacancy rate was so low that I knew I could screen my tenants carefully and only rent it out to good tenants with good rental history, which was exactly what happened. I received numerous applications after the first inspection and found a tenant that has been living there ever since. I purchased this property for $303,000 and then spent $10,000 on a fresh coat of paint minor repairs, and some new carpets. The property was then immediately rented out for $400 per week, which gave me a rental yield of almost 7%. However, in the current market, this property will sell for around $520,000, and the rental income has increased to $440 per week. But if we look at the numbers now, the rental income or the rental yield for this property at the market price will only be 4.4%. This means a number of things. First of all, if I was to purchase this property right now, it would not be cash flow positive. It will be cash flow negative by around 0.5 to 1%. It will also mean that it will be cheaper to rent this property than to own it. If I compare this investment to my most recent investment in Perth, which is a very similar kind of property located around 20 minutes from Perth CBD, it was purchased for $360,000, and the rental returns around $370 per week, which gives us a rental yield of 5.4%. This makes this property not only cash flow positive, but cheaper to own than it is to rent it. This will in turn encourage first-home buyers to buy the property instead of renting it. And that, of course, is going to drive up house prices. And another thing to note here is that investors look for a return on their investments, and that comes in the form of capital growth, as well as rental returns. With such strong rental returns and good growth potential, it could definitely attract investors who don't want to invest in negatively geared properties in Melbourne or Sydney, or investors who are simply priced out of Melbourne and Sydney. Because if you think about it, not every investor has $2 million to spend on a blue chip property in Balwyn or Burwood. From an investor's point of view, if they have $400,000 or $500,000 to spend, their only options in Melbourne and Sydney will be inner city apartments. That's pretty much all you can buy, a tiny shoebox for $400,000. But what's the other option? Well, the other option is that you can spend $400,000 and buy a nice 3-bedroom house that is cash flow positive and only 20 minutes away from the CBD. And that house is usually sitting on a land of 600 square meters, 700 square meters, or even more. Let's now look at this from another perspective. When we buy an investment property, which part of that investment property grows in value? Even if we buy a brand new $1 million house, over time, that house is going to deteriorate and it's going to become less and less desirable. So from an accounting point of view, the house component of that investment property is actually a depreciating asset. And the component that really goes up in value is land. So shouldn't our goal as property investors who are looking to build wealth focus on grabbing as much land as we can? Look, I am not a financial advisor and I am not here to tell you what to do, but these are what my plans are, and I certainly know which one I will choose. And that, of course, is a house on a big block of land over a small shoebox in inner city Melbourne or Sydney. Understanding the mindset of first home buyers, owner occupiers, and investors goes a long way, and it will definitely help you create a more effective strategy and help you identify opportunities in a crazy market. So to answer the question, is it too late to invest in property? My personal opinion is no. There are still plenty of good opportunities out there if you know where to look. Now let's talk about a correction in our property market. Just how likely are we to see a major correction in our property market? In my personal opinion, we are unlikely to see a major correction, but a small downturn is definitely possible. Obviously, the most important factor here is interest rates. If we see a rapid increase in our interest rates, it will no doubt cause a pretty significant correction in our markets as our over-leveraged homeowners struggle to make repayments. And with the term funding facility coming to an end, I personally think we will see higher interest rates before 2024. I'm not talking about a huge rate hike from where we are now to 5, 6 or 7%, but instead a slow and gradual increase that might take us back to 1% by the end of 2024. For those who don't know what the Term Funding Facility is, it is a government program established to provide cheap credit to the authorized deposit-taking institutions, which are our banks, and encourages them to pass on that credit to struggling businesses. The ultimate goal of this facility is to stimulate our economy by injecting it with money. And as expected, whenever the Australian economy is injected with credit, a lot of it goes to the property market. So with this term funding facility ending, our banks now have to source a credit on the wholesale market, which can be much more expensive. We have already seen our major banks increase their interest rates. and this is likely to continue in the coming months and years. This is definitely going to put a lot of pressure on homeowners, especially those ones who have maxed out their borrowing capacity to get into a property. Another factor to consider is the federal election. The Liberal Party have always been very pro-property, and this has been proven over and over again with huge government stimulus programs to support the property market, just like what we saw in 2020. The Labour government, on the other hand, promised to abolish negative gearing during the last election campaign. Just imagine what this would do to the Melbourne and Sydney property markets, because such a huge percentage of investment properties in these markets are negatively geared, and they rely on the benefits of negative gearing to make it profitable. If investors can no longer claim a tax benefit on their negatively geared properties, you will simply encourage them to just sell them. And we could very well see a huge increase in listing numbers, which is going to lead to a correction. Look, I'm not saying this is going to happen, but it is definitely better to prepare for this than to be caught off guard. So to answer our question, will we see a correction in our property market? Well, it is still too early to tell, and it depends on how these factors play out and what happens when our borders reopen and migration returns to normal. But the risk in some of our markets is definitely higher than others. If we now look at the risk to reward, or in other words, the potential for growth, do you think a property in Sydney that is currently $2 million is going to double in value in 10 years' time and become $4 million? Possibly, but unlikely, based on the wage growth that we are seeing and the affordability constraints that are already kicking in. Now, what about a $350,000 property in one of our smaller markets? Do you think it could double in value and become a $700,000 property in 10 years' time? I personally think the chances of that playing out is much higher than a $2 million property becoming a $4 million property. And the reason I believe that can happen is because I have seen it happen. I purchased a property in Launceston in 2018 in a suburb called Mowbray, and that house is now worth mid $300,000. And with the growth that we are currently seeing in Launceston, we could reach the $400,000 mark in the next year or two. In conclusion, I personally do not think it is too late to invest in property. There are opportunities in every single market. We just have to manage our risk and find those opportunities. Don't get caught up in the FOMO, but instead focus on the fundamentals and look for good value in the many markets of Australia. Don't be too fixated on a single market because it will limit your opportunities. I hope you guys enjoyed the video. If you did, please do me a huge favor by hitting that like button right there and commenting your thoughts. Let me know what you think. Do you agree with everything I've said? And don't forget to follow me on Instagram for more daily content. And I will see all of you guys in the next video.